Alright then, good afternoon everyone on Thursday the 21st of March, and we're at the end of a number of central bank decisions. We'll start with the Bank of England and the Swiss National Bank, and then we'll work our way onto the Fed, see what we think come the end of this video. But Bank of England today, a bit of a nothing release, really. I mean, you look at the vote change, right? You can see 8 members of the committee now vote for an unchanged interest rate, previously from 6, consensus 7, up to 8. So, you know, the 2 that were voting for hikes previously are now not voting for hikes, they're voting for it to be unchanged. And the calls for interest rate cuts remain the same, with 1 of the 9 members of the Monetary Policy Committee. Now, what that means going forward, you would expect that to be a bit of a dovish reaction, which is what we saw at the post release. But within the minutes, you know, you could see Andrew Bailey suggesting that interest rates do still need to remain higher for longer. There is still work that needs to be done in order to get inflation further under control, even though we are making progress on it. You know, certainly talks of interest rate cuts are premature, whether they happen in June, whether they happen in August. And obviously we'll need to cross that bridge kind of when it comes to it. We need some more inflation prints, some more economic data out of the UK to really fully make that decision. So it's kind of a bit like a football match, really. I mean, one team goes 1-0 up in the first half, the other team makes it 1-1 in the second half, and you kind of finish 1-1. But slight more of a dovish reaction, because this step towards 2 more members voting for it to be unchanged is a step closer to interest rate cuts. So that is what markets have run with, but they didn't get the follow through, or we didn't get the follow through from the minutes confirming that rate cuts are now on the table. So that brings us then on to the S&B, where we did in fact get the rate cut, a surprise interest rate cut from the S&B, who did note that inflation is back within their target, likely to remain within their target, so therefore they can begin lowering interest rates a little bit. Right, I know it's only at 1.75 down to 1.5, but they were at minus 0.75 to begin with, so they have raised interest rates quite substantially for them, if the last number of years is anything to go off. And then of course they are the first of the 8 major central banks to cut interest rates. A little bit predictable, those. The Simon Jordan came out a few weeks ago back at the World Economic Forum, suggesting that this Swiss franc was a little bit too strong, a little bit overvalued, and they needed to do something in order to get the currency less overvalued and get the price of it down a little bit. A surprise interest rate cut. Is that much of a surprise? Not quite. We were talking about the trade floor this morning, and we were able to predict it ahead of time. But that then, what's that mean going forward? I mean, they didn't comment too much on any further interest rate cuts. Did note inflation. We'll keep an eye on Swiss inflation as we go on forward, but certainly not the strongest currency across the board today. Brings us on to the Fed, though. Fed a bit more tricky to wrap your head around, right? If you've been watching these videos over the course of the week, I was hoping for a hawkish Fed, hoping to be short gold. That obviously didn't materialise, if you check the charts, right? Economic projections out yesterday, right? But the reason why I wanted to be was hoping for a hawkish Fed and wanted to trade gold lower was a couple of different reasons. You look back to last year, from the economic projections, right? The dot plot indicated 3 cuts through to year end this year, right? With inflation remaining where it is, with economic data remaining as positive as it is, you know, inflation rallying again, commodities at 2022 highs or close to 2022 highs, and that is commodities across the board. Oil continuing to trend higher, which continues to put upwards pressure on inflation. Maybe inflation remains a bit sticky and remains a bit more tricky, more difficult to get down. I kind of thought, you know, with stocks rallying the way they have done over the last number of months, I kind of thought personally that Jerome Powell, what he should come out and do is kind of, temper expectations a little bit on interest rate cuts, try to get asset prices down, maybe try to get commodity prices down, and ultimately help to cool down inflation. That's not what he's done. He's seemingly happy to let stocks and risk assets continue to rally. Maybe his thought process on it is, he lets stocks continue to rally, everybody keeps making money. If everybody keeps making money, people will keep spending money. I mean, that's a bit of a risky game to play, because that runs the risk of inflation continuing to move higher. And he seems somewhat accepting of inflation remaining higher. There's no change in the dot plot to reflect potentially 2 interest rate cuts this year. Another we spoke. Was it yesterday's video? We were looking at those dot plots, thinking 3 into year end. Certainly weren't going to get one yesterday. Certainly aren't going to get one in May. That then leaves 5 5 decisions or 5 meetings from the Fed through to year end, which means they have to cut interest rates at 3 of them. If you get another hot inflation print, I struggle to see how they cut interest rates in June. If you get one more hot inflation print, that then includes commodity prices rallying, it includes oil prices rallying, it includes stock prices rallying. All this is contributing factors to inflation. You then get PPI, which can be seen as a front runner to CPI at 0.6 last month. That's a tricky one. I personally don't think they'll cut in June. Then that leaves 4 meetings throughout the rest of the year where they will have to cut interest rates 3 times. I'm not sure they're going to do that, to be honest. Whether they don't cut at all is a different question, as some market participants, the odd few market participants, think. But I just thought he had a bit of a job to do in order to cool down inflation and temper expectations. But he said, kind of, I don't care about that. Let stocks rally. It's a bit of a risky game to play on his point of view, but again, he knows better than me. Well, you'd hope that he knows better than me, but sometimes I question that. But upgraded economic projections, right? They upgraded inflation. Upgraded inflation forecasts. They've upgraded growth forecasts. They have downgraded unemployment forecasts, and they've noted a tight labour market and a continuing tight labour market and all that stuff. Plus saying we're going to cut multiple times this year. It all seems a bit. He's kind of happy to let inflation run hot. If inflation continues to run hot, well, then they're not likely to cut interest rates 3 times again this year, and that would cause yields to kind of reprice a bit, or yields would need to reprice a bit if they are going to allow inflation to run a bit hot, right? If yields then reprice, which you can see over the last number of hours, yields pushing higher aggressively. Maybe they're waking up to the fact that Jerome Powell saying yesterday is a little bit tricky. You can see 10-year pushing higher aggressively, the 2-year pushing higher aggressively. You can see gold getting whacked, which is a bit annoying compared to what I was saying yesterday. The fact that it gets whacked now, I was really considering selling at these highs yesterday, but I didn't, and now look at it. So trust your instinct sometimes. But when you look at the US dollar, you can see Aussie pushing lower, Kiwi pushing lower, Euro pushing lower, Cable pushing lower, dollar Swiss, dollar CAD, dollar yen, all pushing higher. Again, just US dollar strength across the board. Where does that leave equities, though? Equities seemingly don't want to push lower. They don't want to budge lower. And if all these other assets are going in, you get dollar strength, you get yield strength. It should result in stock indexes moving lower, but again, they're just, I should buy them. Doesn't matter what anybody says, just buy these things. You can see, which personally I'm not sure I really agree with it, but it's not. It is not really whether I agree with it or not. Just gotta stay with the trend. The trend is your friend, and this keeps wanting to push higher at any available opportunity. So I think you gotta stay long for stocks for now. Do I really agree with it? No, but it doesn't matter what I said, or it doesn't matter what I say, doesn't matter my opinion, as I already said. But yields, interesting one to watch. Yield strength, US dollar strength. Is the reaction I would have expected to yesterday. Maybe markets are waking up to the fact a little bit that we probably will not get 3 interest rate cuts over the course of this year. Fed have been wrong on multiple different occasions over the last number of years. In my personal opinion, this seems like another one. So let's hope they don't make too big of a blunder, but kind of seems that way for me at the moment. But again, what do I know? I'm just sitting here talking in a video. I'm not part of the Federal Reserve, but we'll cross that bridge when it comes to it in coming weeks and months. Update further as we get on through those weeks and months. But anyways, it's kind of my thought process on the goings on yesterday. These moves that we're seeing now, I think probably the moves to jump on. And that's putting my neck on the line a bit. Goes against the reaction to yesterday, but these moves to me personally make more sense than the moves that we saw yesterday. So let's see if we can take advantage of them.